Welcome back to The Explainer. So today we're looking at an industrial giant that is suddenly trading a whole lot like a nimble tech stock. I'm talking about Rockwell Automation. Now, if you follow the industrial sector, you definitely know this name. But lately, their stock has just been on an absolute tear, sitting right up near a 52-week high. So we have to ask, what is really fueling this fire? Is it just a temporary bounce? Or are we seeing a fundamental shift in how this company actually operates? Just to put this momentum into perspective, Rockwell's stock is up roughly 18% year-to-date, trading right around $457.59. And look, in the usually slow-moving world of industrial manufacturing, an 18% sprint, that's significant. It tells us the market is aggressively repricing the company's future. But to really understand if this surge is justified, we need to pop the hood and look at the underlying mechanics driving all this momentum.
Okay, let's quickly map out our roadmap for today. We are going to start with that Q1 earnings breakout. Then we'll look inside the business at their new growth engines, check on their financial outlook, and finally, try to decode their valuation premium.
Part 1. The Q1 earnings breakout. A massive beat.
All right, so on May 5th, Rockwell dropped its Q1 fiscal 2026 earnings, and the market reacted with an instant 5.37% jump. When you look at the raw numbers, it's pretty easy to see why. Total reported sales grew 12% year over year, climbing from $1.88 billion in Q1 2025 to over $2.1 billion in Q1 2026. But the real star of the show here was the bottom line. Adjusted earnings per share surged an incredible 49%. It leaped from $1.85 to $2.75. Not only is that just massive growth, but it completely shattered analyst estimates, beating expectations by a full 15%. When a mature, established company delivers a 49% EPS jump, you really have to ask, how exactly are they doing it?
Moving to Part 2. Inside Rockwell's business, the global machine.
To truly understand those numbers, we have to peel back the layers of this 123-year-old business. Because Rockwell Automation isn't just selling conveyor belts and factory motors anymore. Just look at the sheer scale of their footprint. We are talking about 26,000 problem solvers deployed across more than 100 countries worldwide. This is a company that generated $8.3 billion in sales in 2025. They have these incredibly deep, entrenched relationships in practically every manufacturing sector you can think of, from food and beverage all the way to automotive and energy. But scale alone doesn't really explain that recent margin explosion we just talked about. To see where the money actually comes from, we need to look at the revenue split. Rockwell operates in three main segments. You've got intelligent devices, which is the physical hardware and smart sensors, and that makes up the largest chunk at roughly 40%, pulling in $3.7 billion. Then you have software and control at $2.4 billion, and lifecycle services at $2.2 billion. So while hardware is their legacy core, the software piece, that's where the real magic is happening right now.
Section 3. The new growth engines, data, AI, and software. Now, this is absolutely crucial. This isn't just some corporate buzzword pivot. It is a fundamental evolution of their entire business model. Just look at the stark contrast in profitability. Software and control boasts a massive 31.2% operating margin. Compare that to 17.3% for intelligent devices or 14.1% for lifecycle services. Basically, software is acting as this high-margin turbocharger for Rockwell's overall profitability. Every single dollar of software revenue they bring in has a disproportionately positive impact on their bottom line. So you might be wondering, who exactly is buying all this software? Well, according to management, we are seeing a meaningful broadening in demand. It is no longer just traditional factory floors. The explosive growth is actually coming from semiconductor manufacturing, data centers, e-commerce, and warehouse automation. As the whole world races to build out AI infrastructure and modernize supply chains, Rockwell's software is essentially the central nervous system making it all work. And that is exactly why they're projecting low double-digit growth for their software and control segment this year.
All right, Section 4. Financial health and outlook. Confident projections.
With those high-margin engines firing on all cylinders, how is management feeling? Pretty confident, it turns out. For the full fiscal year 2026, they are reaffirming a solid 3 to 7% reported sales growth. But more importantly, and this goes back to those expanding margins we just covered, they've actually upgraded and increased their adjusted EPS guidance. They're now targeting a range of $11.40 to $12.20. When management actually raises their profit targets midway through the year, it is a glaringly clear signal that their strategic shift is working even faster than they initially expected. But honestly, what really speaks volumes here is their capital allocation. The board recently authorized a brand new $1 billion common stock repurchase program. A buyback of that magnitude? It suggests they firmly believe their stock, even at these elevated levels, still represents a really solid return on investment. It's just a massive vote of confidence from inside the house. And, well, they can actually afford to do this because their free cash flow has seen a massive recovery. Over the last 12 months, free cash flow has rebounded to nearly $975 million. That is recovering sharply from a trough of about $639 million back in fiscal 2024. This cash generation, it's the lifeblood of the company. It's what allows them to invest heavily in R&D, buy back that stock, and weather any macroeconomic storms. High free cash flow conversion is the ultimate proof that those 31% software margins are turning into real hard cash in the bank.
Which brings us to Section 5, decoding the valuation premium. Is it priced for perfection?
We all know Wall Street absolutely loves a good AI and software story. But the real question is, how much of that future success is already baked into the current stock price? Let's talk multiples. Rockwell is currently trading at a pretty steep 24.32 times next 12 months enterprise value to EBITDA. Now, when we contrast this against their closest peers, ABB is sitting at 22.59, and Schneider Electric is all the way down at 16.90. The broader peer group average? That's closer to 14.2. So why on earth does Rockwell command this massive premium? Well, it mostly comes down to their pure-play focus on the North American market, combined with their significantly deeper software integration compared to those European rivals.
Because of that massive premium, analysts are honestly a bit divided on what comes next. Some models, like Ticker's mid-case target, suggest the stock could hit $568, which implies a very healthy 24% potential return from current levels. Simply Wall Street notes the most bullish analyst targets are around $525, while the bears are eyeing a pretty steep drop down to $282. And the primary risk feeding those bears? If major capital expenditure projects in sectors like automotive or food and beverage get deferred, Rockwell's 24 times multiple doesn't exactly offer a lot of safety net.
So that leaves us with the multi-billion-dollar question, doesn't it? Is Rockwell's premium valuation fully justified by its incredible momentum in data centers and high-margin software? Or, up 18% on the year, is this stock simply priced for perfection, leaving absolutely no room for error? Look, the Q1 numbers were undeniably a blowout, but maintaining this kind of altitude is going to require flawless execution. Take a close look at the data, weigh that high-margin growth against the steep multiple, and see where you personally land on this fascinating industrial turnaround. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.